What's cracking, investors? It is February 3rd, 2023. This is the video like takes 30,000 to a million, although that's going really slowly and there's going to be a lot of changes to the account. I'll show you exactly what's going to happen in a second. But first, I really want to talk about the Apple's earnings. So the earnings came out and basically these are the numbers. It's kind of hard to see here. This is from Google. The expected earnings was 195 and the reported earnings was 188 per share, which is a surprise of minus 3.64%. Okay, so the surprise just means the difference between analyst expectations and reality. And same thing with the revenue side of things. So commonly, by the way, earnings is referred to as the bottom line, and then revenue is referred as the top line because of the way the accounting is done. Revenue is always at the top and then all the expenses and etc. And then you reach the actual earnings at the very bottom. So that's why it's called bottom line and top line, in case you didn't know. Some people still don't know. So there you go. That's why. All right, so the bottom line was 188 per share, or a surprise of 3.6% to the negative, and then the revenue, the top line was 121.65 billion expectation, and then a reported 117 billion.15, or a surprise of minus 3.7%. So 3.7% less than analysts expected. And analysts were pretty optimistic, even though the company experienced quite a few issues from the supply side of things. If you remember all the drama from the Chinese factories and whatnot, and them switching over production to India and other countries and whatnot. So there was a lot of drama with that, and I guess the company got slowed down more than anticipated. Or worst off, it could be the fact that demand for the iPhones was just that weak that it couldn't really be fulfilled, even though they didn't increase the price of their phones this year or last year. So one of those two things is correct. It's hard to tell which one. From what I've done, I've talked to some iPhone sellers, right? Some Verizon stores and whatnot. And the managers there tell me in person that demand for the Pro was fairly strong last season, and the demand for the regular 14, the iPhone 14, is pretty weak, like weaker than I've seen in a long time. So I'm guessing that the Pro version sold in line with other years, and the regular 14 did not. I heard another statistic that, because Apple doesn't really release their phone sale or their product sales units specifically anymore, but they do break it down in category. But when it comes to the phones, I heard that 75% of the phones sold were actually the Pro version instead of the regular version. So that's kind of crazy. And usually the way that it works is most of the Pros sell in the beginning, and then as the time progresses, more of the regular version of the phones start selling whenever the less willing to spend money are starting to purchase the phone. They opt out for the cheaper versions as time goes on, because they don't really care about the latest and greatest. They just want a good phone at a good price. So timing's not as important. Anyway, it looks like from the breakdown, the phones were significantly under what last year sold, maybe like by 8% or something like that, or 6%. And then the iPads were about 8% higher than normal. Services, I think it was about in line. And there was about a 25% decrease or something like that on the iMacs as well, or the Macs period, their computers. And I think wearables was also somewhere close to being in line. But anyway, I think the only thing that was a positive surprise was basically iPads for some reason. So that's kind of the breakdown. It's a very rough breakdown. You can probably find better data online. Doesn't matter. But what I'm seeing here is that if the iPad demand was this high, maybe the phone demand could have been high as well. And it's in a way good news, because it could be the supply side that's actually pinching the demand rather than the other way around. So it's worse if people have the money. I'm sorry, it's better if people have the money and no phones yet, because that demand can always be fulfilled. It's worse if there's a bunch of phones out there and no one to buy them. No one has the money or willingness to buy them. So in a way, it's a little bit of an encouraging report. Now, when it comes to the actual news, this is my account, by the way. We're gonna review it in a second. I'm gonna go to Apple. When it comes to the actual news, initially they were reported negative in the after hours run, but then it started looking up later in the after hours. It was a little bit more volatile, and then a big upward thrust today against the market. So Apple was actually up on the day 2.44%. It was up as much as 4% in the very beginning. When compared to the markets, let's go to the SPY here. Excuse me. SPY. Not PYS. As compared to the regular market, which was down 1.06%. So a big divergence there. And in the beginning, look what happened here. The market started off at negative 1.3% at one point. It rallied and then fizzled off again. The NASDAQ was kind of interesting. Let's see the Qs. Invesco QQQ. It had a similar ride as the S&P. It was down as much as 2.25%, then briefly into positive territory, then fizzled down to a minus 1.78. So the market's really kind of hit it on the chin here, except Apple. And because I'm really just a holder of Apple now and a couple of other monthly payers, my account was up 1.5% overall. I'm lucky to have done that. I actually started selling because I think this rally is a little bit too much. I've actually started selling some shares. I sold 100 shares and I gained a total of $15,573. I bought back a couple contracts which were going to expire worthless. So it cost me just a couple of dollars in order to make that trade. So that's good. I have a bunch of other call options that expired today, including 2 of them that were in the money at 149. So unfortunately, I missed out on those 200 shares that are going to be sold. And I missed out on that $5.25, $5.11. Market is live-ish as we speak. That's why the screen is white. The after hours is still going. So I missed out on that $5 gain per share. So that would be 5 times 200. I missed out on about $1,000. Which sounds like, a lot of money, but considering the fact how yesterday went and today went when it comes to after earnings reporting, I feel kind of lucky. I mean, I would have been fine. I'm fine, missing out on this $1,000 because I am not suffering, as big. If Apple decided to follow suit with the Metas and the Amazons and whatnot and Microsoft's take a big hit after earnings, then I would have had a little bit of protection. And so now I lose $1,000 of gains for that protection, but it could have been, it could have just as well gone the other way. But anyways, it's time to do the account review real quick. Let's go to the investing tab. I'm sitting, as you can see, at almost 181,000. 1 week performance is 3.79. 1 month is 29%, which is huge. 3 months is 14. But this one's the really important one, is the year to date. I'm up 32.42. It ain't no Lucid. It ain't no Tesla. It ain't no EV stock, but it's still doing. Let's see how Lucid is doing, by the way. It had like a 200% rally. I would short it if I was confident in timing, and I should have shorted it. Look at this. It's down almost 4% today. Down 10% on the week. But look at this 1 month chart. 83. Look at this 3 month chart. It went all the way down to 6 and then all the way to 12. Over 12. So that was over 100% rally here. What about Tesla? Let's see. I think Tesla had a good run as well. Okay, yeah, same deal here. Bounced off the bottom off of the $100 level, and now it doubled to 190. Let's see on the day. It's actually up on the day. So Tesla and Apple defying the market movements. Well, I mean, Tesla and Apple are kind of like the two stocks that have been the leaders, anyways, of the tech entire tech sector. They're kind of like the alpha dogs, right? And when it comes to investing at the moment. Um, and instead of FANGs, I think we're gonna have to start coming up with some new acronyms, because to me, the market leaders right now, it's more like the AAA and T, right? Like Amazon, Alphabet, Apple, and then maybe Tesla. But I think there's definitely a bit of a change in leadership here when it comes to the market. It's a big reshuffling happening right now in the markets. Back on topic, I still haven't done the account review. The 1 year performance is about flat from this point on, which is not bad considering, there was a big upward thrust at this time this year. What do I mean I doubt? I know for sure that I'm not going to get to that $200,000 mark that I did last year at this time by February 15, because I just don't have that much Apple stock. Even if Apple experiences like a tremendous rise from here and goes up like $15, I don't think I'll reach the $200,000 mark that I reached back in February last year. The peak of this account was $214,000 over here in August 16, whenever Apple was 184, something like that. But then I experienced this big drawdown all the way down to 140s and 130s, all the way here because of Smith and Wesson and Paramount and Chinese stocks. So I took it on the chin, and I lost about $84,000 worth of unrealized value. And during this run up, as you know, I've gotten rid of my Paramount position, Smith and Wesson position. Let's see how they're doing. So I sold Smith and Wesson around the $10 mark. Right now it's 11.17, so I could have had much better pricing. That's okay. Paramount, I exited about $20 and on average, and now it's 25. So I'm missing. I left a lot of money out on the table. If I had been a little bit more patient, like I discussed in the previous video, I probably would have been like near all-time highs right now, at least well over 200,000. But I wanted to exit and try to be safe because I just don't believe in this recent rally. It's a little too sharp for me, a little too much exuberance going on I think no reason. I mean, rates are still going up, so I think that this market rally is going to roll over. Let's see how the S&P did in the 1 month chart here. So 29% for me. I don't think we can judge year to date, but it's very similar. So 29%. Let's see the SPY on the 1 month chart is 7.54. So beating the market about triple in percentage terms year to date. But definitely I think on the 1 year, I'm winning. So I'm about flat. So I'm basically winning on every metric now. Let's see the 3 months chart. I'm back on top. That's right, I'm winning. Okay, I'm back on top on every single metric. 1 day, 1 week, 1 month, 3 month, year to date, 1 year, and of course all time. This is the all time chart. And I want to talk to you about that because it says 150% gain over the last maybe 4.5 years. I started investing in August 28, 2018 with this account, so it looks really flat because there was just no money out of it. But see how it says $72,000 and 200? I think I'm going to take that money out. So it really starts from a $30,000 where I actually started this adventure when it was $30,000. I decided to start doing a video log to record, my progression, my mood, my thoughts, my market thoughts, whatever inflection point in the market, if things are going well, if things are going badly, how I'm handling it. That's one of the main purposes of this video log. And the other one is just to share it with anybody who wants to watch it, to encourage other people to get out there and record their process. It's a form of journaling, and I think journaling is really helpful for investors in order for them to learn from their mistakes. It's kind of like watching a videotape of you playing a sport or a game and then reviewing how you did and the moves that you made so you can learn from your mistakes. So that's one of the main purposes of this video log that I'm doing. And lastly, actually, I do enjoy helping others and educating. I mean, I'm a teacher by profession, kind of. I'm a tennis pro. I used to be a playing tennis pro, unsuccessful one. Got injured really early and didn't help me climb. But even if I did climb, I don't think I was going to get that far. Maybe like top 1,000 in the world if I tried really hard. So I wasn't going to be like winning Wimbledon or anything. But then, it was a bit of a good news that I got injured because I started teaching and I kind of started developing a passion for teaching. And so that's been my profession for a long time. Of course, I do odd things here and there. Like I'm not a very wealthy guy, right? I just kind of save my money. I try to be really good at investing, and I do have other accounts. This isn't my only account. I have a retirement account, another side account. So, but this one is public, and I'm gonna keep it public. Hopefully, I take that 30,000 to a million. I know it seems like an odd thing to take it out right now, but actually, I don't think it's odd. I'm not taking the money out of the peak, because I'm trying to take them out at somewhere where I actually put the money in, which is during 2001. I'm sorry, 2021. I put that extra money in. I decided to I wrongfully decided to start adding a lot of money in around this zone. And I'm kind of exiting at the same zone, so I'm trying to minimize the impact that money had on my actual account. But still, this numbers will change. It's meaningless now, the 150%, and it's probably going to double once I take the money out, to like over 300%. And that number is also going to be meaningless because it's going to be more meaningful and more realistic than the number now, but it's still not going to be realistic because of the extra money. I don't know. I can't calculate the effect that money had. But anyway, it's going to be a better, gauge, I think, moving forward. Not in the past, but moving forward, all the way to millions. We'll see how it progresses. Other news, we've had here a bump, like I said on the previous episode. They're gonna bump it in the next couple of days, the percentage on Robinhood from 4%, and they decided to bump it up 0.15%. And so now the cash that I have is going to be collecting that, 4.15% per month. It's going to be about, I don't know how much, like $15 or something like that. I don't know what the amount. I don't want to do math right now, but here's the interest that I've been earning so far in the first couple of days in February. So if you times that by, 15, so I'm gonna be getting a little bit less than $15 at the end of the month if this cash just sits in the account. It's not a huge payout, but quite frankly, it's a lot more than a lot of savings accounts are offering. So it's not a bad idea to just leave your cash in Robinhood, especially if you have Robinhood Gold like me. You're gonna get that extra boost in the percentage. I know that Wealthfront is offering 4.05%, I think, right now. Somewhere around there. It's over 4%. You can leave that in there. They have a cash account option on Wealthfront. Or just look for the regular bank. I mean, you can put it in CDs or whatever and earn some extra interest on your cash if you want. This is the most defensive the account has ever been, and I think it's mostly because I'm trying to take the money out. I don't usually like to hold much cash like this. I like to work on margin, and this account hasn't seen this much cash in quite some time, especially this, you know, 30 plus 15, $45,000 of cash that's going to be sold over the weekend by executing the shares. You can see the buying power here is 19,845 in cash, and then an extra grand margin. I've set it at a grand limit because that's the free. You get a grand for free with Robinhood Gold. Then you don't have to pay interest on. But anyway, so it's going to be a lot of buying power, just pure cash, not even like margin cash, just pure cash. And this account hasn't seen that since February of 2020, so it's been about 3 years. What else about the account? Apple was up, like we mentioned, 2.17%. Realty income down 0.34. Main Street Capital up 0.38. So these are going to be giving me dividends pretty soon on the 15th. These two tickers, O and Main, give dividends every month on the 15th. And Realty income is going to give me $110. Main Street Capital is going to give me $219 or thereabouts. I have $30,000 in realty income. So, for example, if I had $100,000, this number would be, tripled, so I'd be getting like $350 per month. And then this amount is not likely to actually get decreased over time with like some funds. You got to be aware that there are some funds that actually have decreasing dividends, but this one increases dividends over time, and it's likely that it's going to keep increasing them until it runs out of good properties to invest, which is hopefully very far in the future. Um, and Main Street Capital is the same, although they do not do real estate. They do kind of small business loans, but they're really good at it. And so far, they haven't had to cut their dividend. As you can see, I have $40,000 invested in there, and the last dividend they gave me was 218,000. 20,000. I wish, $218, which is currently getting automatically reinvested. But so if I had 100, if I had quadrupled this position and have 160,000 instead of 40,000, I'd be getting from Main Street Capital, 850 or a little bit over dollars per month as a paycheck that I can just live on if I wanted to, or pay bills, or do whatever, or reinvest. But I'm not gonna do that because I want to own some Apple, I want to have some cash, I want to have some realty income, and I want other stocks. I just haven't, gotten a chance to dive into exactly what I want to buy. I mean, I wanted Paramount and Smith and Wesson, but then they started running up too high too quickly, and I sold out a little early, admittedly. I've never been good at timing. I just let some call options execute, and that's how I got rid of the position. So I do want these other stocks. I want Goldman Sachs, but it's a little bit overvalued at the moment. I want a lot of stuff, but it just too expensive for me, and I do think this rally is a little bit overdone. And over the next 2-3 months, I expect the markets to kind of fade out, because the reality is that the Fed is still tightening, the interest rate is still going up, and which makes financing a little bit more difficult. The benchmark for investing, the risk-free rate is higher, and so everything is going to be moving down the risk curve towards cash. And because of that, I'm thinking that this rally is a bit overdone. I think even if this is the beginning of a new bull market, which is very well maybe because this upward impulse has been super strong, there's going to be a correction on it. This is not gonna be the lowest level of the year. There's gonna be a lower level at some point in the year than this. Like, I'm willing to bet a lot on that. And I am a betting man. Okay, so this video has gone pretty long, but I feel like I got a lot of thoughts across about what I think the market's gonna do. I talked a little bit about Apple's earnings. I am positive on Apple, like, in general. I just think that it's gonna be a tough maybe next 6 months. So I'm gonna be treading lightly on the company. I'm still gonna own like 400, at least 300 shares of Apple, which is gonna be my main position still. I'm just not gonna be overhyped on the company. So I do think they have a good future. They're gonna beat their earnings either next year or the year after that. They're gonna beat their 2021 numbers. Like, I'm pretty confident. I just don't know how long it's gonna take. There could in fact be a recession coming around the corner. I mean, the rates are pretty high. We got all kinds of signals. The yield curve inversion signal that has never been wrong, among other data like slowing economic data, production data, consumer data, like deflation in a lot of raw materials. I mean, there's signs all over the place that there's bad economic times ahead. So I think the markets are kind of realizing that and betting that they're really betting super heavily on the fact that the Fed is going to reverse course pretty at the first sign of recessionary data. And I think that is why the markets are rallying. However, another big reason, in my opinion, why the markets are rallying is because there's just so much cash out there. Not everybody, but virtually everybody that I've talked to that operates with any kind of cash has a ton of it sitting on the side. I'm talking like 50 to 90% cash. Not even like 20% cash. Just 50 to 90, like they're completely cashed out. And so all it takes is just a little bit of that money to trickle back in because of some sort of optimism that we're getting for unknown reasons. Some people are speculating there's the whole debt ceiling debate thing, the operations of the Treasury has like a QE-like effect or whatever. But so it's changing the sentiment in the market a little bit, but there's no reason other than that added liquidity to be bullish in the markets at this point. I'm not a mega bear. I'm generally pretty sanguine. I just think that short-term moves in the markets tend to get overdone and get ahead of themselves on the upside and on the downside. So I think there's going to be a bit of a correction, but we'll see. All right, that's it for now. This movie is movie. This episode, this video has gone way too long, so I'll hopefully make another one on calendar spread soon. I mentioned that I might make one on that. Maybe I'll do it tonight. Maybe tomorrow. We'll see. We'll find out. But I'm looking forward to sharing how to put on a calendar spread. That's it. Peace out.